Investing Insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
G'day, how you going? It's Phil Tarrant, co-host of Property Investing Insights with the team over Right Property Group. We're flying solo today. I only have Victor Kumar, founder, director of Right Property in Studio. He's been allowed to come on by himself, which gives me quite some concerns and fear, but I reckon we'll be all right with it all. Victor, all right? How's it going?
Yeah, mate. Good. Yeah. So in family, we have got, in our household, we've got three priorities: family,
Yes.
friends, and business.
Yes.
Your name doesn't come up in any
It doesn't?
of them. No.
It's fair enough. I don't fit in anywhere. I'm the leper of property investment in Australia. But people either love me or loathe me. That's what I found over the years. When they want something from me, they seem to like me, but sometimes when I say stuff, they don't particularly like me too much. And, I'm happy to call out some of the missteps of the property investment industry as well.
Absolutely.
Right?
I heard about the property buzz.
Yes, property buzz is I think it's one of the most popular things we do now, but it's a bit polarizing.
Yep.
Someone's got to do it.
Someone's
got to do it. Someone's got to say it as it is.
That's it.
I'm very considered, obviously, and not too guarded, but I don't know. See how we go with it all. But how you been, mate? Good.
Good.
Yeah. So tell me how you spent your budget night. Did you sit there and you were prepared with a nice bottle of red and your notepad getting ready, or did you do what I did and just yell and scream at the screen for about 20 minutes?
Actually, there's a photo floating around with the staff of me sitting down on the floor in our TV room with a glass of red, a notebook, and a pen.
Oh, so there is actually
that does, because I thought, and this is by far one of the most significant budgets that have been handed down from a tax structural change point of view, and plus it was also a good excuse to have a glass of red on a Tuesday. Yeah,
no, it is pretty good. I got left alone in my house. They left me alone. They all went to another room and. Because they didn't want to go, what is he doing? What's going on here? It's just crazy. Trying to tell my kids, and they just look at me, just going, "Yeah, okay, sure, no worries." But anyway, I was down in Canberra for the latter part of the budget week. We had stuff going on down there, and I was fortunate enough to sit in the in the gallery there for the response from the leader of the opposition, and then do all the sort of stuff after that, and chat with all the pollies around it all, which was all quite interesting and engaging. And I think a lot of people were sort of just questioning whether or not everyone in the Labor Party or government actually read the budget papers, because there's certain things that they missed in it which people were sort of scratching their head about. And I think a lot of that now is really coming to realisation. So, a lot's been said about the budget. Lots been said about what the budget has sort of outlaid as what the future for property taxation is going to look like. So I'd like to have a chat about that today, rather the details of what's going on, because everyone knows no one actually knows what's going on, because it's all got to go through and get debated and go through the Senate. But how or if this has any relevance to Design Your Decade. And we've been talking about this now for well over 12 months. Well, nearly well over a decade, but well over 12 months in relation to this special focus on Design Your Decade. And what we have said is that your portfolio should be robust enough to be able to deal with seismic shifts and challenges, and whether or not this is significant enough to call it that. But that's the context of today, mate.
Absolutely. And if you've been listening to our podcast over the years, right from inception, we've always said one thing consistently, that tax is just a consequence of investing. It should not be the reason to invest. Yes, certainly it helps with the holding cost. I agree with that. However, that shouldn't be the basis of your investing, right? So as far as Design Your Decade is concerned, the rules of the game have changed. But so what all that means is perhaps the strategy in terms of the progression of the properties may change slightly, but the end goal does not change. The concept does not change. And yes, there is a lot of spruiking going on social media, people putting up pretty graphs, people putting up a lot of information there. We need to be very mindful that this is not legislation yet, and we don't really know how exactly it's going to land. And so let's not get caught up in the detail. We know definitely that there will be change in terms of taxation as far as property is concerned. Where it exactly lands after all the horse trading that they do in Parliament is anyone's guess, and I suppose we'll know for sure come July.
Yeah, and there is a lot of horse trading going on, and a lot of people won't actually understand the depth and layers of that horse trading.
Yep.
To try and the government obviously objective is to get all of these sort of budget recommendations in the legislation. It's obviously a political process that needs to take place, and will all of it go through to be legislated? Probably not. Will bits of it? Yes, there will be. And from what I understand, it's going to get chunked up. Not going to try and put it through all in one big hit. They're going to try and get the easy stuff through first, and then the harder stuff, which is probably around sort of trusts and all these type of things, will probably get debated. And you may see concessions there. You may see some variations or changes to it. So we just don't know. So I wouldn't be making definitive decisions right now on what the future looks like based on hearsay and what ifs with the budgets. But you've been very clear on this, Victor, that you're at a philosophical level, your portfolio should be secure and robust enough to not have to duck and dive around strategy all the time. It should be consistent, but there's tweaks and fringes in the edges. A lot of people still get absorbed with this idea that tax is a strategy, negative gearing is a strategy. So let's just quickly dispel that, if you can do that for us.
Yeah, no, absolutely. So if you look at it from a analogy point of view, right, and you're traveling to a destination, and your GPS says that that road is closed because there's a major accident there. You've got two choices, right? One is you sit in the traffic and wait until the obstacle clears up. So this is the people that are, if I bring it back to investing, people that are stuck with like a deer in the headlights. So they don't know what to do. So they just sit there. The other cohort would find an alternative route or take a pause, take a meal break until the obstacle clears away, right? So when you look at negative gearing in its sense, we've always said it's a sovereign risk, and the sovereign risk has come through, right? So we've got no control over it, and it's no sense jumping onto social media and bagging it. And all. If you really wanted to make a difference, write to your local member. Maybe that will have some level of impact. And the initial market reaction is always it hits a pause. Yeah. There's a sharp decline in inquiries. And then once people really know what they're truly dealing with and becomes normalcy, the market returns to where it needs to return, right? So there are several moving parts here. We need to understand what the moving parts are and address it accordingly. The biggest thing that we need to address is obviously finance. So if you look at finance in itself with the bank's calculators taking negative gearing into account, now as soon as they take that away, and if you look at, say, as an example, NAB, when they took that away last week in terms of their calculator, your lending capacity dropped by 46%. 46%, right?
Wow.
So a word of caution to the listeners, if you have a pre-approval, you want to cross-check, double cross-check that with your lender. Don't just take your broker's word for it, because you don't want to be taking that pre-approval to an auction and get locked in and not be able to pivot out of it when you find out that the lender is no longer willing to lend you as much money. Because 46% is a big drop. Yeah. It's almost half of your borrowing capacity. So if you've got a pre-approval for $1 million, all of a sudden you've just got $540,000 in borrowing capacity.
Yeah.
So
and there is one of the arguments for these changes to negative gearing is that you'll have less buyers in the market with more dollars in their back pocket to buy.
True.
So the idea being that should put negative pressure on prices. That's the logic.
Yeah, it is the logic. But if let's see how it really plays out. Naturally, if my borrowing capacity is going to drop and I still want to continue investing, I'm going to go down to the cheaper prices in a property where I can get that price. And naturally, that's where the first home buyers are also. So it's not really helping that in that sense. So we will see a clear divide in the types of investors out there. One that will be buying the trying to chase the growth and look at dropping their purchase price, so getting to the 540 in this example, but still investing, right? So they are your equity chasers. Then there'll be others that will be the yield chasers, which they'll be going more and more into regional areas and perhaps not so pedantic about the fundamentals and compromise on that to get the yield. So there will be a lot of people that are taking knee-jerk reactions right now, and not a measured approach as Design Your Decade comes into play. There will be a lot of people that will be hurt financially or slowed down in terms of their property journey because they've simply gone down the wrong path.
So you're going to have more investors playing around those cheaper end of the market who are going to be clashing with first-time buyers. But just, assuming, and 40-something% drop in serviceability is huge. I've heard like 20s and 25s, but that's considerable, which for a lot of people may mean, it's going to put a halt to their property investment journey or to slow it down. And again, the argument would be from the government, this is what we're trying to actually happen to make property, inverted commas, more affordable. However, they've said that these rules don't apply for people if they're buying new, right? And you get to make a choice whether or not you want to do your 50% or your indexation method moving forward. So a lot of that's still going to come back to your ability to service a loan and your ability to get finance. So, changes to serviceability, you can still, the lenders will still assume negative gearing on new build properties.
New builds, yes. Yep.
So the idea being is that they want a lot more investors to buy new properties.
Yep.
And we're talking about Design Your Decade here. If you look back in the past, anecdotally, a new build property bought today in 10 years may be worth about the same amount as what you paid for it today.
Yeah. Well, if you look at what's happening in the market, right? So immediately after the budget night, we were negotiating on a couple of townhouses that were relatively new, so they're less than 12 months old. Yeah. And the vendors just simply moved the goalpost, and it eventually sold, not to one of our clients, but it eventually sold 4% higher than our top price on there in a matter of days, right? So straight away, the brand new prices are moving up. You overlay that with the cost of construction keeps going up because of what's happening in the Middle East. So you'll have more investors in that market as well. So more demand. The pipeline for construction is 12 to 18 months at best. So that's going to jump in price. Yeah. So we'll be overpaying for these properties. Yeah. And naturally, people will shun the established properties. They'll take a small dive in terms of price for the next couple of months. And then there'll be this clear gap of, okay, if brand new is sitting here and I can get established properties, forego the tax deductions, I will pick up that growth spurt that'll happen once normalcy returns into the market, right? Yeah. So this is where, like when I said in the beginning, you got to change your strategy. The strategy is not, the change in strategy is not necessarily the type of property, it's where you buy and how you buy. Yeah. So a good example of it would be anticipating that there may be some changes to the trust and for those that are acting on advice and putting properties in a trust so that they have perpetual borrowing capacity, all of a sudden that's gone. Yeah. So will you buy in a personal name? Will you buy in a company structure? Anything that you do today, I think you need to get really good advice. So part of when I'm doing the reviews with my clients post-budget is that we're starting to look for more efficiencies within the household budget. So simple things like reevaluating the insurances. I'm not talking the insurances on the buildings. I'm talking about life insurance. I'm talking about income protection. Seeing whether you can, with good advice, that's not us, so that's the financial planner, with good advice, moving that into, say, a SMSF environment so that it doesn't impact your normal cash flow. And therefore, you're picking up. So in my example, in this case, earlier this year, I moved some of my insurances into the SMSF. And I picked up about 9K in cash flow outside of SMSF, right? Now, of course, if the cash flow is now, the expense is now sitting in the SMSF, right? So doing things like that, obviously increasing your rent. So, not the $2 a week, but more, looking at all of your moving parts. So this is a good time to look at some really good financial housekeeping. If you can still qualify for the loans, turning your loans back into interest only, and finding that money from within your expenses to hold on to the next asset. Yeah. You and I have both been through post GFC, right? And how when no one else was buying, we were just buying left, right, and center.
Great days.
Great days, yep. And the same opportunities are coming now, apart from the fact that you don't have the tax deductions necessarily. Yeah. When you get to the other side of this hiatus in the market, naturally the market then rebounds quite significantly. It's a matter of just holding on, and for some, it may mean that you pause and come back and build your granny flats, build your secondary dwellings, get lots more efficiency in terms of how much rent you're getting to create that cash buffer to then help you purchase the next one, right? So there's a lot of housekeeping that we need to do. What we need to watch out for is that pretty much every buyer's agent is going to pivot towards commercial.
Yeah, you think so?
Yes.
But, there's still the same tax regime connected with commercial property. It's but from a cash flow point of view, it's very different.
That's right. Yeah. So commercial property, as far as I could tell from all of the readings I've done, they still have got the negative gearing attached to it, right? So it's the residential part that's not that doesn't have the negative gearing attached to it. And I'll come back to the negative gearing in a minute. So commercial, a lot of buyers agents will start spruiking commercial. Yeah. And we have to be very careful because they are learning at your expense to get into the commercial arena, right? So be very mindful of that and don't just do a knee-jerk reaction. Don't go too early.
Yeah, that's good counsel. And coming back to negative gearing on existing properties, what a lot of the commentary running up to the budget and post-budget sort of being weaponized by certain cohorts of the community. And that is, we had to get rid of this evil negative gearing because it was this, that, and the other, right? What a lot of investors don't understand is that it sort of still exists. It's just deferred.
That's right.
So it's just like you're investing in a trust or a company structure now, in that if the property's making losses, you withhold those losses connected with the property, and then and losses being at a cash flow level. When the property starts making money, which in time it should do if rents keep going up and you don't change your debt position, you just use those losses at that point in time, so you don't pay tax on the income you get once it turns positive, and then gets to a point where it's all squared away and then you pay tax moving forward.
Yeah, absolutely.
So it's sort of still there. It's just not happening immediately. You're not offsetting against your income today.
Correct.
You're offsetting against income the property will generate tomorrow.
Yeah. So a couple of, I wouldn't say fact check, but grounding for this, right? So yes, negative gearing is deferred. So what they've done is, let's say you had a business and this business is making a loss, you're able to offset the loss against another business, right? Now what they've said is now it's coming back to that one business. So the business being the property investment. So you can't offset the losses of this property investment against your business, which is your PAYG income, right? So it's all quarantined within there. So it is still there. As far as we can tell, we don't know for sure until it becomes legislation. So it is still there. It's just that it's not in the front end, right? So you will still be able to claim it at some point in time. It'll be drip fed back to you as your property becomes positive cash flow. Yeah, there's a lot of spruiking about certain mortgage structures that people can do where you can still, in inverted commas, negatively gear the debt. Be very mindful in terms of ATO scrutiny on this, and don't do anything fancy. Keep it very basic so that it doesn't become something that you get raked over the coals when you do get audited.
Yeah, and a lot of people, they think, well, what's my hack? What's the workaround? Like a lot of property investors probably should have stopped investing some time ago because they probably shouldn't be investing because they can't financially, or they're just waiting for something to happen for it all to come unraveled. And this may be it for a lot of people, who knows. But there's always like, don't worry, we'll find another way. Don't worry, we'll find another way. You've got to be very cautious and careful about this. Maybe this is a signal that, maybe that's it. There's a good reason why 90-something% of Australians own 2 or less investment properties because, the rhetoric again, talking about weaponizing the rhetoric around it, saying that property investors are wealthy and rich, they're not. No, they're everyday Australians just trying to get ahead.
Yes.
Get ahead.
Yeah.
I think that's been forgotten, and that's where a lot of pushbacks come from.
So a lot of this spruiking will come via setting up SMSFs, right? So take advice first. Don't just take see a buyer's agent is not qualified to tell you to set up an SMSF, right? Needs to be a financial planner. So when you're looking at an SMSF, there's 2 models where you can just say, go to the accountant and say, don't want advice, I want you to set up an SMSF, I've made up my mind, right? Or the Puritan way and the better way is go through a financial planner, map things out, and then set it up so that you're then taking a strategic approach towards not losing your nest egg, your retirement nest egg. Yeah? So there'll be a lot of people spruiking about it in the SMSF. Then there'll also be a lot of people spruiking about fancy mortgage structures, and there will be a lot of, if you look back in the olden days, right? So, and I'll bring up Caboolture as an example in Queensland, and Robina in Queensland. The 2-tiered marketing, where back those days when there wasn't as much online information, I'll call them spruikers. So the spruikers would come down, have seminars here in Sydney, then fly them up and say, this is the last 4 lots left in this development. Then the next stage will be 50K more. You need to secure this today. Everything's done and dusted in that day, in that one trip. And they'd used to cross-securitize the properties with their home. So they never found out that the valuation was dodgy. So they ended up paying 80, 100K more than what the property was worth. Yeah. That's going to raise its head up again when people start going down the rabbit hole of brand new properties, off the plans, dual keys. Yeah. Don't buy the property for the sake of buying. Buy the property that'll get you to your goal without any tax benefits taken into account.
And that's what it needs to be.
That's what it needs to be. As simple as that.
That's how I've always approached investing. I've never negative geared anything. I don't have anything negative geared. Everything's always in structures. So,
But you take the tax benefits when it's there, but you're not reliant on it.
You're not reliant on it, right? It should be able to wash its face. So are you doing a blanket, don't buy new? Or
No. We would buy new for someone that, if it makes sense. So if you look at the design your decade, your growth property, your set and forget property, your easy pay down property, and then your cash flow property, and then your generational property. For some, it may be that the growth is a slower growth property because we're buying a brand new, because we also want to mitigate a lot of their tax scenario. Because they're earning, say, 400, 500K a year, right? And they're bleeding 100, 150K in tax. So it does make sense to get that in the front end so that we've squared a property away without taking too big an impact from the cash flow. But then we need to support that potentially slower growth with other properties where, if I look at the tax regime that's going to come in, if you have an established property where you subdivide and add to supply, so in other words, build a second house, or you knock down the house and put a duplex where the duplexes can be separately titled. That's the finer print. Then you can actually negatively gear it, right? So on the outset, you bought a property you can't negatively gear, and then you can change the outcome.
So it needs to be a structural change to the title.
Yes. So that's where granny flats don't come into play.
So building a duplex, so splitting a block. So splitted blocks, may become more attractive moving forward.
So this would be the structural change in the design your decade, where we're bringing property number 3 forward to property number 2, and perhaps not buying property number 3 because we're working on property number 2 first.
And back to new build then. For someone on a high income, it may actually make sense. So you're foregoing potentially rapid growth or a diversified growth, because you might be able to get 2 instead of 1 if it's a new build property. But assuming some of those tax offsets you're going to get as a result of it. And, you'd rather the money potentially going into a lower growth property than giving it all away to the government, who doesn't seem to be able to spend it too well as it is. But there's also all the other consequences around depreciation,
correct,
and stuff like that, which can add up to a significant amount of money on a new build property.
That's right. Yeah. So whilst we're buying the newer properties, so less than 12 months old.
So is that what is defined as new build under the?
Yeah. So it can be tenanted.
Okay.
But you can't have change of ownership, right? So one ownership change, as far as I can read in their big document.
So if someone bought it off the plan, and then you buy it off them
within the first 12 months.
Within the 12 months of it being bought off the plan.
Correct.
That's new.
Yes.
I didn't realise.
Yeah.
Okay.
So there's a small gap in the market.
So it means
right?
you don't have to put your 10% deposit down, wait for someone to get built. No. You can actually buy it.
Yeah.
Holeless bowlers done.
Or approach someone that's got a property practically complete. Right? Yeah. So you're just waiting on the fixtures and fittings to go in and for the OC. So we literally 5 weeks away from
OC
finish.
being occupancy certificate.
Yes. Yep. Having said all of that, right, you're not just buying the brand new because you're getting the tax deductions. The other fundamentals still need to be ticked off, right? So owner-occupiers need to be more than 60% owner-occupiers in that area. Yeah. It needs to be close to infrastructure. It needs to have diversity of income. So it can't be in a mining town we're putting on a duplex. Yeah. And, just because of the tax deductions, you're buying that. It still needs to be within your employment hubs. And it still needs to be suitable for an owner-occupier to buy it off you. Because at some point in time, you will sell, right? Whether it's planned or unplanned. So we need to look at all of those things still. And this added bit is, okay, now I've got a choice. If I can continue with my cash flow, I found the cash flow within my family budget to hold an established property, there's less competition there, right? Or if I absolutely need a brand new property, in the current budget definitions, then I'm going down the path of not the off the plans, but complete and near complete dwellings.
So this is just, again, there's shades around the design your decade.
Yes.
I think the way you framed it, where your property number 4 may become property number 2 and slice and dice things. But when it comes to new build properties, and I've seen it before, any of these sort of changes come with government. I know of people who have bought in sort of greenfield suburbs in and around Melbourne, and they've bought properties, and there is certainly not a skew of 60-40 of first home buyers to investors. Essentially, it's all investor stock. Correct. And no one wants to rent them, right? That no one wants to rent them, and they're struggling selling them because other investors are going, well, I don't want this. It's out of kilter, right? So this is going to happen.
It will happen, absolutely. Yeah. So the trick here is not to buy in greenfield states. So meaning of greenfield states is that, establishing a new suburb and all. So you're buying infill developments. You're buying properties that have got, say, if it is 12 stages, you're buying in stage 1 and it's already on to, say, stage 11. Right, so you've got surety in terms of value. You've got surety in terms of traction.
So it's okay to buy the end of a cycle. Like you don't want to be at stage 1 of stage 15, right?
Because no, we don't know how it's going to come, right?
No.
But if it's already, most of the stages are already done, we know where value sits.
So let's look at that conceptually. Then I'm thinking of somewhere like the ponds, which a lot of people would be familiar with.
Yes.
So the ponds is pretty much sort of done.
It's done now.
It's done now. They're going out further, like in Vineyard and Schofields and Rouse Hill and areas like that. But the ponds is largely done.
Yes.
Yeah. So if you're early on in the ponds,
that's speculation.
Yep.
Yeah. But if you're mid development, so mid in terms of stages, and let's say ponds had 10 stages, and you're at stage 5 or 6 at the moment, it's okay to buy, right? Because we've got established value. I'm not buying the brand new unless I'm chasing that tax deductions. I'm perhaps buying the more established ones, because you generally have larger lots. You generally have all of the defects readily apparent, because that's another challenging thing, right? So how do we know with the escalating costs and supply chain issues whether there's been any corners cut.
Well, there's build quality isn't always up to scratch, and you don't know what's inside the walls or inside the roof, right?
Correct.
It's very hard, even though you get inspectors. I think some of the winners around this whole budget thing will be building inspectors and valuers, right?
Yes.
And again, you're gonna have to be buyer beware. Not all these professionals are created equal.
Yeah. And so if we look at all of the moving parts here now, right? So we've got at the moment lesser inquiries on established properties. I mean, I'm talking to agents and every Monday I do the rounds with all agents.
Are they calling you up now?
Yes, they are.
Ooh,
yeah.
Okay.
Yeah.
Interesting.
I know. It's changed overnight.
Well, let's talk quickly about buyer's agents then, because are they calling up all the buyer's agents, or do you think there's going to be a softening to the buyer's agent space?
Huge softening.
Okay.
Huge softening. Yeah. Because most of them have buyer's agents, and there's some really good ones out there. Yeah. Of course, we're the best.
But you are actually the best. You won the.
Oh yeah, that's right. Yes, we
you got it was buyer's agents
of the year.
Agency or agent?
Yes.
Agency.
Buyer's agency of the year.
Buyer's agency of the year, the Australian.
Yeah. I couldn't get the good looks in, so I didn't win that one.
Buyer's agency.
Yeah.
So you are the best.
Yes.
Well,
yes. I'll take that.
According to you and them, I'm not saying anything. So there's lots of really good buyer's agents out there.
Yeah. But there will be a lot of these buyer's agents have started after COVID.
Yeah.
Right. And there's been an explosion of buyer's agents. They haven't seen a market like this. They don't know how to correct portfolios, and everyone is a hero while the market was an upward track. Yeah. So there will be a rationalization of the industry, and I'm already seeing that with quite a few buyers agencies where employees are being let go of, and part and parcel of change. Yeah,
these things happen.
These things do happen. So when the market continues, the good players will be around. The winners of this, of course, is the ones that were doing house and land packages and off the plans, right? So everyone's going to gravitate towards them.
Well, and this is a key point if you're tuning into this. Buyer's agents for new build properties typically aren't buyer's agents.
No.
They're called something else, and there's many different names for them, project marketer being one of them, right?
Yes.
So they'll tell you, we'll help identify the right property for you in the right location, ... Or here's one here.
Yep.
And they probably get a commission. They're getting a commission paid probably from the developer.
Yep.
And they're probably expecting you to pay them a inverted commas buyer's agent's fee or consulting fee. So be very, very careful. A lot of people fall into this, right? I was up at the ARIC conference, Australian Real Estate Conference on the weekend on the Gold Coast, and just chatting about buyer's agents. I was chatting to someone and they said, we reckon there's about 5,000 buyer's agents in Australia. We think it will end up between 15 to 20,000.
Wow.
And I was like, I don't know about that. But I think now maybe 5 or less than 10% of all property investment transactions probably has a buyer's agent connected to it, right? No one knows the number, but anecdotally, that's what it sort of sounds like.
Yep.
So 90% of people are buying without a buyer's agent.
Yep.
And you can be absorbed in this buyer's agent sector because, that's a lot of people using them and you chat with them all the time. But, there's a lot of people, most people making decisions without using a professional buyer's agent. They may be getting advice from a financial planner or an accountant. And sometimes financial planners and accountants are also on the project marketing side of things as well, right? So make sure that's all disclosed. If your accountant or financial planner suggests you buy a particular property and as a new build property, I'd ask him if they're getting paid around it, right? That's fair.
That's right. And if you're being referred by any, including people like us, right? So if you're being referred to someone, the question you need to ask is, okay, is there any compensation coming your way if I do business with them? And have you used their services, right? So, or have you vetted them? And that's really important to us, especially in today's market. Yeah. So coming back to the agents, we immediately after budget night, pretty much the inquiries dropped.
Phone calls started coming in with the agents as well. I was talking to an agent actually this morning, and he was saying that they no longer are doing off-market deals because none of the buyer's agents can buy, right? So most of the off-market deals, in inverted commas, were being farmed out to buyer's agents that were transactional. And that's no longer happening. So they're actually launching the property. Can you explain something to me on this basis? Again, chatting to someone, and to me it sounded that buyer's agents send real estate agents briefs saying, hey, I've got all these buyers and they want to buy 4-bedroom properties to like they actually send briefs to the agents and the agents look through them and go, here you go. This is the off-market properties or pre-market. So is that how it happens?
Part of it.
The briefs go out to agents, and the agents try and fulfill those briefs from buyers agents. I always thought it was a little bit less it's not structured like that, because that sort of, to me, just goes, well, I don't know.
You could do a blanket email yourself. Just go into realestate.com and just shoot those emails out. Yeah.
So I'm looking for this. What do you got?
Yeah. The reality of it, and we do end up with quite a few of the agents with their on their broadcasts as well, and you can see the list of buyers agents. So typically 40 of them. So it becomes a feeding frenzy, right?
Yeah, okay.
So we don't play in those fields.
Yeah.
We've got relationships with agents 25 years, 30 years.
And this is the point for me, right? Because we're manufacturing all these buyers agents, and all they do a course and they get told, do this, get on the list, and there's nothing unique around. There's no uniqueness around that, and where's the value for the client, right?
Yeah, absolutely.
Genuine to actually get genuine off-market stuff from an estate agent. It's very, very difficult, or you need long-term, 25 years of relationships, because otherwise you're just another name and email address.
That's true. Yeah. And to some of the agents, when we inquire, we are just a name, right? Because they're not listening to this podcast.
No.
They're out there selling, right? So if you look at those broadcasts, now obviously we don't play in that, and the agents that we work closely with, they also do those broadcasts as well, right? Yeah. But they tell us, now this one's gone out to the off, and that's say it with a smile. This has gone to the off-market deals.
Yeah.
Right. There is no such thing.
Yeah.
There is no such thing. So now that's changed. Everything's being launched, and the feedback from the agent I spoke with this morning was that they were taking this property to auction. In the initial stages, there were 7 potentials. They ended up with 1 on the auction day.
Really?
Yeah.
And purely because of these potential legislative changes.
Yeah.
People got less money, or they're scared.
Both.
Yeah.
Both. Yeah.
And fear is a funny thing.
It is, yeah. Fear of the unknown.
Yeah, fear of the unknown. For people to be decisive in these environments, they need to be pretty sort of robust. But again, if you haven't been buying under a regime of negative gearing, nothing's really changed for you, other than maybe you might change the structure that you're buying into the future, or using the existing structures that you have, and we're not providing financial advice at all in that regards. But for a lot of people, not that much has changed. The basic fundamentals still remain.
You should be investing via fundamentals, not reacting to media and not reacting to government changes of tax. Now, if you are truly building up your portfolio, you're taking the tax totally out of it.
Yeah.
Right. So, as we've been saying, and if you've been listening to this series of Design Your Decade from December last year, consistently we've been saying that get your equity out while you can, and always be liquid. Liquidate your equity as much as you can, so you're always opportunity ready. And if you look at how this is going to pan out, now, of course, no one can predict the future. I've got my crystal ball from Kmart the same way you've done. Mine's a little bit more tinted because I've used it a bit more. Yeah. So if we look at what's likely to happen in the future, we have got by far the highest assessment rate for finance in the world. Yeah. Once the market slows down enough, APRA's likely to look at the assessment rate and drop that assessment rate. Right? So your 540 that we're talking in that example might change to 750 at that time.
And no doubt the banks will start applying pressure the other way back to APRA, because banks are in the business of lending money.
Yeah.
And if the size of the loans that investors can take on have been shaped by 20, 30, 40%, they may still be doing the same amount of loans, but they're going to be at a lot less rate.
Yep.
And that will certainly impact the bank's bottom line. We saw when the budget was handed down, did you see the bank stocks drop? Like CBA dropped 10% in a day. Like imagine you're retiring on that day thinking that you're going to liquidate your CBA stocks. Bam, 10% gone.
Yeah.
But, it's so intrinsically connected to the property market.
It is.
Banks need lending to make good money.
They do. So during the GFC, right, when lending became really hard, and not so much the lending, but the ability to hold on to properties, there came out specialist loan products from the lenders. They were the second tier lenders where you were able to purchase a property and you pay interest on half of the loan. So let's say it was a 900K loan. You'd pay interest on the 450 and it will be interest only. And on the other 450, you'd capitalize the interest. So they're allowed to. And it was a product that was approved from ATL, right? So they went and got a private ruling and so forth, right? So you will see quite a few innovative products come out.
Always is.
Yeah, always is, right? So when you have a slowdown in businesses innovate. When you get into something like that, you need to make sure that any lending solution you have, you need to be able to refinance out of it. You never, in today's environment, you should not redline your borrowing capacity.
Yeah. Well, I think there's going to be new versions of mortgage prison coming up for a lot of people, in this concept of mortgage prison being people stuck inside these loans they couldn't refinance because of changes to serviceability, right? Like, and that may be the case for a lot of people who are on, negatively geared properties right now looking to extract the equity, right, to load that up. They may not be able to even meet the serviceability on new stuff because they're having a negative gearing at it. But I reckon there will certainly be a new sort of application of mortgage prison for first home buyers who subscribe to 95% loans at the biggest loan they possibly could do on property, which may be in negative equity, right? And they just won't be able to. They just won't be able to refinance their way out of it or sell their way out of it, which is a big problem.
Yeah, it will be a big problem. And one of the things that you need to be mindful of is that most of your properties will go backwards in value in the immediate future, likely. Because the banks are going to put an accelerated risk on it. So
don't expect vals to stack up. True. If you're looking to refinance, would be
if you're
the
looking
point.
to refinance, and also if you're buying as well, it could be that banks heavily exposed to investors in that area, right? So they'll try and de-risk it, right? So how do they de-risk it? They try and lower their loan-to-value ratio. Yeah.
And this problem is, dancing with the devil in some way, because you contract the price, and if it doesn't come up, you can't go back and renegotiate the price.
Correct.
You've got to find the dough from somewhere, right? And you're right. Banks will just structurally de-risk. They'll just go, because they know, well, take it or leave it, mate. You can go to another bank if you think you're going to get a higher val.
That's true. And so if you're planning to go to an auction, double, triple check your pre-approval that it's actually there at the level that you've got in writing, especially if you've taken your pre-approval before 12th of May. I would go back to the broker and reassess it. Get it reassessed, right? Don't leave it to chance.
Brokers is so much busier now having to reprice all this stuff, right?
Yeah. So if we look at that, so that's something that you need to do from a design your decade point of view is don't go in blind and make sure you double, triple, quadruple check your pre-approval. So looking at the 4Ds, we talked about defense, diversification, I've forgotten what, debt, all of those, right? So in terms of diversification, this is where if you've already got an established residential portfolio, you could switch into commercial. It may mean selling down. It may not mean selling down the part of the portfolio. But don't switch too early either, because front end of your portfolio is really all about growth, right? You're trying to target equity, you're trying to target growth. If you're wanting to give yourself a bit more of a buffer, maybe get into this cosmetic renovation game. This would be really good.
And we spoke about this, you telegraphed this, that we're probably moving into a realm where the market ain't going to do the heavy lifting. You're going to have to do the work to get the lifting out of it. But back to commercial, though, one thing I would urge caution on, and again, this will probably be a question for your broker and or buyer's agent, is that banks don't like releasing equity from resi portfolios to move into commercial portfolios. So to actually cash up in order to start buying commercial, it can be quite difficult to actually pull that out of a resi portfolio.
Yeah. So if you look at 100% debt exposure, most commercial properties will be slightly negative year 1, year 2, year 3, and then it becomes positive, because of the rent reviews and so forth. There are ways to get there. So obviously the pure way is to free up the equity or sell down to get to the equity and get into commercial.
Selling down's fine.
Yeah, selling down's
pulling
fine.
equities. Pulling out equities harder.
Yeah. Now there are ways to pull out the equity, and this is where you get to the specialist mortgage brokers, and this is one of the few times it is okay to cross securitize. Yeah. So as a standalone, the bank may not want you to pull money out and then use that as a deposit in commercial, especially if it's the same bank. But if you gave them the residential property to say, okay, we use this in conjunction, so they'll do a hybrid loan.
Yeah,
right?
bundle them up.
Bundle it all up.
Yeah.
Now, it does make you a little bit illiquid because one needs to value up for them to release the other. So you don't do that unless you've got a big portfolio.
Yeah.
So there are ways to get into that. Right now, given these changes, the business case for cheaper commercial does come into play.
Yeah.
When I say cheap, I'm still talking 650 plus, right? So
much around at that price point?
Far between. That would be the highly competitive one, right?
Yeah.
Like the true, good, safe, less competition commercial, you're talking, 2 mil plus.
Yeah.
Yeah. It's just that the deposit requirements is 600K plus for something like that. So most people may not have that cash around, right? But everyone's got 100, 150 to buy the 650, right? That's where the competition is. However, if you so long as you're not getting into these sell and lease backs with the industrial warehouses where the developer's leasing it back from you, that's cooking the books. Yeah. So you get legitimate leases in place, and you've looked at it from a worst case scenario. It has some merit, right? So you don't have to buy brand new. You could buy a small commercial to get your negative gearing if that's your fancy.
Yeah, I need to look into the negative gearing. It depends what structure you're buying it in, right? You know, I'm not across enough of that to really make an observation on it. So these are just reorientating your design, your decade based on changes.
Correct.
It's not a wholesale change.
No.
It's a wholesale shift. There's just nuances now that maybe make it a little bit more complicated or may change the cadence or the sequence of how you build out a decade.
So generally when you've got your pod of properties, you're starting to seek efficiencies in cash flow property number 4. Yeah. Now you may have to seek the efficiencies in property number 2. That's the only change.
Yeah. And means good buying, right place, right time.
Correct.
I think a lot of investors that have potentially bought in regional locations with price points which are now sort of city price points, where a whole bunch of other investors have bought may find themselves in another version of mortgage prison, and that is they're going to have properties that other investors don't want to buy anymore.
True.
And probably the owner occupiers aren't there for it and might not be worth what they paid for it, right? So would you be keeping, in terms of where and what to buy, capital city centric in this environment?
If you can get the lending for it.
Yeah.
Nothing wrong with buying major regional, but be mindful that more than ever, given the price point, major regional may bounce yet again because of the buyer's agency activity in those areas, right? And buyers full stop in those areas, because it's a price point, right? Now, it may be that if you want to be metropolitan, now's the best time to switch into townhouses, villas, units, right? Be very safe on that. You don't buy into a high rise, don't buy brand new. But, you can get fairly decent yields and good projected growth. It will be slower, no doubt. Yeah. You just don't want to buy into traditionally oversupplied areas, and you need to be double, triple checking the supply chain in the area. How many DAs are parked, how many sites are being worked on, and you can still play the game in the metropolitan areas.
Okay, that's good, counsel. So next time we get together, Victor, we may have seen some of this budget noise becoming legislation.
Yes.
Whether it's going to be all of it, who knows? So watch this space. It's going to be an entertaining sort of period ahead of us. But you must have been getting a lot of phone calls recently.
Our clients are very well educated, right?
So because they tune into this podcast, obviously.
Yeah, of course. Yeah. One of the best podcasts.
Nothing what you guys do.
So the only thing that we're getting is for some of the clients that are borderline in terms of whether they can hold on or not. We're working with them to bring forward a granny flat construction and all this sort of stuff. We're doing a online Q&A, and I'll talk about changes with portfolio on next Tuesday, the 2nd of June.
Okay.
So jump on our website if there's any tickets left on there. And this is, we're very mindful of keeping that a smaller group. So definition of smaller in this case, probably 500-ish, where we can then get to the people and guide them through after we've given them information. This is where you need very strong guidance and not get caught up in the social media swell, the panic out there. If anything, if you can afford to hold on to your property, it's not going to compromise significantly in lifestyle. So look within your household budget first. Don't sell any properties at this stage. I want to remind you of how Queensland land tax situation was, and a lot of people sold.
They did.
Yeah. Look at Queensland now, and that legislation did not come through.
I know people that sold straight away when they were going to start bundling up your whole national footprint, and which was just like it goes to show how stupid people can be sometimes, right? And I'd like to say there's a fair bit of stupidity in this budget, so let's just wait and see what happens. Wait and see what happens. You can check out Victor and the team at rightpropertygroup.com.au, RIGHT propertygroup.com.au, across all the socials as well, and you can send them a message in a DM and tee up time to speak to you. There's sort of a bit of process there, isn't there? But come armed with all your numbers and your facts, because Vic can do his job better.
That's right. I need to know what I'm playing with first to give you guidance.
Needs to know. It's good. Well, that's very sensible. Just considering the different aspects to your portfolio now and how you might be bringing forward and buying decisions or selling decisions to maintain the sort of depth of your portfolio as you design your decade. And guess what? These are some changes. Exactly what they're going to look like, who knows? But what I can guarantee is that there will be more changes to tax in the future. What I can guarantee, there will be a change in governments in the future as well. So who knows? Making big decisions for today when maybe it might revert back to how it used to be in a couple of years' time. Like you just don't know. You just don't know. So it's tough. So make sure, you say it all the time, the fundamentals need to be critical, and tax becomes a consequence or an outcome as a result of it, rather than driving your strategy. rightpropertygroup.com.au. Thanks for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.